Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
So welcome everybody. We're excited for another edition of our Multifamily 0 to 1. So today we have Yann with us. She will introduce herself in a minute.
Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice.
My name is Marcelo Cazini. My background is in IT and software development, and I am a local Houston CCIM member with all the CCIM commercial designation trainings. I'm also a multifamily investor, and I have my own commercial real estate. And I also, before multifamily, I was doing single family fix and flips, but quickly realized multifamilies made sense and quickly migrated to it.
So this is Claudia Rubio. Well, most of you guys know us, so I'm gonna be just quick. I was born in Colombia, South America, and we've been living here in Houston for 7 years already. And I'm a real estate professional. I have a degree in architecture, but my background is in asset management. Somebody needs to be, okay. In Colombia, managing our properties. And I have a National Apartment Association IREP certification, which means independent rental owner professional.
And I'm an IT security consultant. I've been doing that for 25 years. I had my own businesses around that. We've had businesses around real estate, hard money lending, and other businesses together. And we discovered multifamily a couple years ago, and we have never looked back after that. Today, we are general or limited partners in around 800 units in different markets, and we closed our first syndication this last December here in Houston.
All right, and with that, Yann, do you want to introduce yourself?
Jiun?
I don't see her. Oh.
Sorry,
Okay.
I was muted.
Okay.
I thought I was providing the feedback there. Okay, so I am an electrical engineer by training. I work in the semiconductor industry, actually same as Charles, that he used to work in the semiconductor industry. I did not have any real estate background, and my first endeavor was into the multifamily syndications. So we go over that later, but currently I am only passively investing into 37 in total. 12 of them have sold, and I'm investing in Arizona, Florida, Ohio, Oklahoma, Oklahoma, yes. Tennessee and Texas.
All right, that's great. Thanks, Yann, for the introduction. So with that, I just want to give anybody that want to introduce themselves. We're all here to learn about each other and make relationships that we can help grow our business. So if you want to introduce yourself, go ahead and raise your hand there and unmute yourself. And you can tell us about your experience. Okay, Sherry, go ahead.
Good evening, everybody. My name is Sherry Alford. My husband and I just joined the Sumrock group as foundation students earlier this month. We are very excited to get into multifamily investing. Our history has been in single family, doing long-term rentals, flips, vacation rentals, and learning the ropes of syndication, and really excited to meet this really supportive group.
Awesome, welcome.
Welcome.
Thank you.
All right, anybody want to introduce themselves? All right, go ahead, Jason.
Hello, I'm in Houston as well. I'm looking to syndicate my first deal. I'm passively invested in 4 deals and just looking to learn more.
Thanks, Jason. Anybody else want to introduce themselves?
I'll introduce myself. Hi, I'm Ann Lee. I just joined the Samrat Group as a PM student, and I've invested in one syndication, $500, and I'm just looking to learn how to co-sponsor. Not sponsor my own, but maybe co-sponsor first.
Awesome.
Good.
Thank
Good.
you. Welcome.
Thank you.
All right, so I'll go ahead and I just want to, so we know, I have a little poll question here about your experience in multifamily, if you want to answer that so we know everybody's experience. So if you're brand new and never done any real estate, if you're already a single family landlord, if you're a passive investor, and if you already led a syndication or an individual owner. So just so we know who do we have on the audience here. I'm just gonna have a couple more people that needs to vote, and then we'll move on to our questions. All right, so let me share the answers here. So we have one person that's brand new, so welcome. And if you hear anything that you don't know what we're talking about, feel free to ask any questions you have. We have 5 people who are brave single-family landlords, and then we have 8 people who are passive investors, and we have a couple that are already owner and syndicator. So that's awesome. All right. So with that, so typically our questions are broken down into 3 sections: is learning how Yann got started. So we call it at the 0 stage. So we'll ask her some questions about how she got started, and then how she went from 0 to 1. That's why we call this multifamily 0 to 1, how she got her first investment, and then after she got the 1, and how she became so successful with so many syndications after she got started. So from that, let's go ahead and get some of the questions out of the way for getting started.
Yes, John. So excited to have you here today. And so let's start at 0. When you just told us that multifamily was your first step, right? In real estate? You just told us that.
Yes, yes.
Okay.
Okay, so I am the maybe stereotypical Asian good student. I was told that, you know, study hard, get a degree, find a job, and, you know, and then nothing after that. I'm not told about anything after that. You're supposed to just work and then retire and whatever it is. So that I've just been doing that. I went to school till couldn't get higher in the degrees. So found a job and worked for 15 years or so without even thinking a whole lot about, you know, investment or retirement, or, you know, I've been doing the 401k, like everybody say, put in money and then the company matches and so on and so forth. And then about 2015, something in my job situation sort of changed and sort of made me think, oh no, this job will not last forever. Um, I started to think, okay, now I need to have something else. And I think before that, Charles is here, but I don't remember. He had been talking to me about this multifamily investment thing that he's doing. He mentioned it a few times, and I didn't really. I listened. I said, "Oh, that sounds good. Yeah. Uh-huh." Until I got to the point where I really was seriously thinking about what I should do for myself. That when he talked to me again, I said, "Okay, now I'm paying attention." And I think at that time he actually showed me one of his distribution checks after a property was sold, and I looked at it and I said, "Oh, that is good. That is very good. I think I listened to him a little more after that. He told me about this um, um, mentoring training program that he recommended me to look into it. Uh, Actually, Charles has pretty much explained how everything worked in a syndication situation to me. And you all heard him speak, and he's super analytical. It really speaks to me too, also. So I went to this weekend R2R event. I think a lot of folks here are Sunrockers, so we know about the R2R event. And I actually decided to join the program before I went, but I thought I should hear it for myself. And I joined the foundation program and went through the training and started investing. So that's the story from zero, I guess.
Awesome. So what in the multifamily type of investment was attractive to you?
The passive investing part of it. The fact that all I have to do is choose a sponsor, choose a deal, and I really don't need to do anything. I mean, Charles, well, this is the mailbox money uh, situation, which I loved because I have heard that a lot of my friends are into real estate as their um, investment strategy. I did not want to be a landlord. I did not want to fix and flip. I did not want to do all that work. So I'm lazy. Uh, so the fact that there is this thing called a syndication where you can passively invest in a project like this, that part spoke to me. And then uh, the mechanics of the project. I mean, it's not complicated. I could understand that. So numbers work for me, and I guess that's it. I didn't really look at other type of real estate as any alternative. I mean, it spoke to me. It sounded good, and I just went for it.
Okay.
Okay. Okay. So moving on to from 0 to 1, how you got to your first investment. So I assume you took most of the education that you needed to get to that first deal from Charles, what he told you, and from Brad's group, right?
Yes,
What
yes. I mean,
other sources? Did you read any books? Did you anything else?
no. At that time, no. Subsequently, I've heard. I mean, I've have more contact with folks, others, um, people doing multifamily investment outside of the Sumrock Group. But my initial education was all from, of course, Charles, the initial setup, and through the group's training material and talking to people. I think as a passive investor, I really wanted to um, talk to people that have been doing it and uh, get some experience from people that have been doing it for a while, or even other new people like myself. We like to compare notes and all that. So it is there is that's I am still in the sum up group, and then a lot of people ask me, okay, you're a passive investor. Why are you still, you know, you should know enough sponsors by now to invest with. Why are you still in the group? Um, I my answer is that I like the people I meet in the group. I think the networking that I do within the group is much more, how should I say, much more efficient. everybody I meet in the group is either already doing it, wanting to do it, on their way to doing it. So it's a lot really more efficient. I meet a lot of people in meetup groups and like meetup group other events. But then I still do like to meet people there, but I don't think I have ever had a deal that I invested in that I met somebody outside in it from a meetup, just like that. So it's a little harder for me to really get to know people. So it's so yeah, I think I went a little bit off topic there, but
No.
That's fine. That's fine. Okay, so when you felt you had enough education to go look for that first deal to invest in, did you have any specific markets in place, any specific criteria that you wanted to find out?
at first I was hoping to look for something local here in Dallas, in the Dallas area. I didn't really set myself a strict criteria at the time, but I guess I would have been more comfortable looking for something in the local area. And the first few couple deals that I had in was privy to were all, I think most of them were in the Dallas area. So I didn't really have to say no to anything that came about. But I was more comfortable looking for something local to me here in the Dallas area.
And then that first deal, how long did it take you to find it once you started looking for a deal to invest?
I was a little, it was, let me see, what was the date? I joined March in 2015, and the first deal I invested in June of 15. So that was 3 months, and the close date was July. I know Charles, when he calculates, he's looking up now. Charles calculates IRR from the closing date. I think a lot of sponsors, no, invest date. He uses invest date. A lot of most sponsors use the closing date. That's a month apart. So if it's a short period, that makes a difference.
Right. Yeah.
So I mentioned both. The close date was July of 15, so that was about 4 months.
Okay. So you took your time.
Yeah, that's it.
And your first deal, was it what kind of syndication was it? Was it were you looking for something small, something big? I mean, how many co-sponsors you had on that deal?
At that time, I didn't really have a preference as to how many sponsors on the deal. Now I know a little. Now I have a stronger opinion about that, but at the time I did not know enough to really know the difference. Oh well, I didn't really make that a criteria that I used to select. So that deal was a single sponsor. It was a 200 unit deal, which was fairly not small. That it's in, well, I think, I know Charles is also in this deal. He actually pointed me toward that deal, actually. So I knew the sponsor from actually, I met him at R2R and I talked to him, I think once, a couple times maybe. But Charles pointed me that way, and I talked to the sponsor again, detailed about the deal, and made my first investment.
Got it. So for somebody who is starting to be to start now as a passive investor, and you specifically just said that maybe your criteria has evolved there. What is your best advice for somebody who is starting now as a passive investor? And then I know a lot of times people are, maybe they want to be a syndicator, but they're also going to be passive investors first. So I think this is a good advice, no matter if you're a syndicator or a passive. What would you be your best advice for somebody looking to be a passive on their first deal?
In general, of course, you get your education, and you have to know what you're investing in. I think everybody get asked, this is the first thing you say. You have to know what you're doing, at least to a certain extent. You can't know everything at the very beginning. And I am more of a, I think Brad uses this term, ready, aim, fire. Ready, fire, aim, right? Ready, fire, aim. I thought I was ready. I found a deal that thought it was okay. I fired, just went in, because my mindset at the time was a little different. I felt that I haven't done anything for 20 years, 15 to 20 years, that I really need to start as soon as possible. So I pretty much pulled the trigger. Maybe I hindsight 2020. Well, this is that was a very, very good deal. So I lucked out. I hit a jackpot the first time, and it sort of spoiled me. Every other deal I wanted it to be like that. So and I know it can't be, but still, you sort of have that in the back of your head that deal was good. So okay, advice. I keep going off track. Know what you're doing. Know what you want, because at that time for me, I wanted to get into something really quick. But if your strategy is a more of a long-term thing, you can afford to look more closely, choose what you want, and what type of deal you want. For me, I don't really, I shouldn't say I don't care, but I'm diversifying between total return or cash flowing deals. If you need the cash flow as your income, you look for that type of deal. If you for a long-term investment, it's the total return that you want. That's it sort of changes what you look for, what type of deal you look for. And know your sponsor. Like I said before, the first deal, this is a single sponsor. I come to realize that usually in the PPM there should be some type of language which says that if something happens to the sponsor, what can be done, what should be done. But you really don't want to get to that situation. So for a single sponsor, there's always that little bit of a risk that, okay, what if he gets hit by a bus or something? What happens with the project? Or win the lottery, yeah. But I look around right now, there are not that many people as a sole sponsor at this point. I don't see a whole lot of people doing that. Mm-hmm. So mostly they're partners, and so that sort of is how it is right now, and that's how I would choose to invest with.
Yeah.
So Chris has a question. Go ahead, Chris.
Yeah, sure. Yann, what I'm listening to you, and I'm, you said you joined in year 2015. Mm-hmm. So in 2015, there was a little bit of a trouble in the Texas economy, and things oil was taking a little bit of a dip. So it's kind of a scary time to get into anything, and real estate as well. So is there something, I guess I'd like to I guess your thoughts as to, what your thoughts were going into that time period, and I guess any particular things like, I guess what was your best experience? Any kind of home runs or anything that exceeded your expectations? And then on the flip side, what's the worst experience, and any anything you might be able to offer with with that to any kind of stories there as well.
Ooh. Okay. In terms of the timing when I started to invest, the market situation at the time was, I mean, it's something that you always think about, but for me, the timing was I needed to start to do something. And the fact that real estate is an investment backed by actual physical property, my thought at the time is that market can go up and down. The asset is there, as long as you can hold long enough through the downturn or through whatever market situation. It's better than I could do in stock or anything else that I was actually doing at the time. So I don't understand stock market. I couldn't, yeah. So I figured something that has a real asset that would, for me, would be much better than anything I could do myself. So timing wise, that's it's just because I needed for myself to start at the time. I didn't really try to time the market. I mean, no, you can't really. So better late than never. That's what I was thinking at the time. As for home runs and not so good ones, this first deal was a home run. I mean, Charles was in this one also. He actually mentioned it in his session 2 weeks ago. This one closed. It was how long? 2.5 years or so. Roughly tripled our money.
Wow.
I'm not going to go into detailed numbers like the IRR or anything, because Charles going to correct me if I do that. But that was a home run, really. I think it's the best deal I have so far, or close to. I mean, one of the best deals I've had so far. And as for things not so good, I'm so sorry, Charles. You're also in the not so good one with me also. This one up in Oklahoma that we actually lost about 15% of our initial investment. So
Wow.
yeah, and so the and I know the next questions will be, how do you know, hindsight 2020, what do you know now to not do? For I don't know. Because I for that the deal that didn't do so well, I mean the number looked good to me at the time. I guess one thing I could say is that we all didn't really understand Oklahoma market at the time as well as we should have, maybe.
Mm-hmm.
And for that particular deal, Charles also mentioned that certain things happened to it that we would not know at the time of investment. So things happen. When all of these PPMs or all documents say that past performance does not guarantee future performance, true. That is true. Because I mean, at least the first year or so, all of my investments are with people that have already done this, have a track record, that sort of have a reputation in the group, uh, type of a syndicator. So I would say you would think I'm probably safe with my investments. That not everyone did well, so as well as could be.
That Oklahoma deal, was it something that was maybe a natural disaster, or was it something related to the sponsor, or any kind of tidbits on that?
Uh, Charles, yeah,
Charles, wanna?
It was a disaster, but I'm not sure it was natural.
well, there was some water issue that I really did not fully understand what happened there. And then of course there was this city development changed the area so that we it wasn't easily accessible, uh, things like that. I mean, we did do an on-site visit at the beginning of the investment, and it looked good to me. I mean, I liked the property. I did notice at the time, oh, you have to, it is not a straight way to it. You have to sort of drive around was it a shopping center or a car dealer or something? I can't remember right now, but then it didn't occur to me that that would turn out to be a pretty big issue at the end. So hindsight, but that's when sponsors talk about how much traffic goes by the property, signage, how visible it is to people that's just driving by. That actually is important. So yeah, you learn things.
Yeah, for sure. So Manish had a question. Manish, you want to go ahead and unmute yourself and ask your question?
Yeah, thanks, Marcelo. This is my first time, so hi to everyone. I'm based out of New Jersey, so I'm glad that I've joined this. Just a quick question to you. So, being a passive investor, so I know when you have a relationship with any syndicators, so you know that. You know his track record, and you know what to see on those, and you basically you kind of you have some trust on that, right? But if any new if the deal comes from any new syndicator to you, so do you trust those numbers, or on at your end also you go and do your own research in that market, and try to see whether whatever is mentioned in the PPM or the financial from this indicator is matching with your research?
I don't do full underwriting when I try to vet a deal, but I do look at the numbers that's presented in the spreadsheet or in the business plan. So as far as I'm concerned, the deal, what I look at, there are three things. What are the facts? What are the assumptions? And what is the plan? So the facts, I mean, there are things that you can look up yourself. What they talk about the demographic. They talk about the market, the location, the employers around, what type of employees are around, those kind of things. The median income, those type of numbers that are available to you. You can verify that. Those are the facts you can verify. The assumptions, what they assume, what the tax, um, uh, property tax, how much rent they assume they can get, what type of rent increase, what type of um, other incomes, what they assume that they can do, and that you probably need a little bit of experience or go through some trainings and go through typical numbers to know if these assumptions are make sense, or how risky it is to you, if the numbers are higher or lower than you think is reasonable. And another thing is, what is the plan? How do they plan to reach what they assume they're going to be reaching? So if they're saying that they're going to be, I don't really have a good example, but it said I'm going to raise rent by 10%. That's high, but are you actually proposing a way to, or a rationale as to how we can get to that point? I mean, is that clear? Do they know what they're doing? Do they know what they want to do, and things like that? What was your question? I think I went off track again. As to verify the deal that's pitched to you, that's pretty much what I do.
Thank you.
And Yann, so you mentioned that you don't typically underwrite the deals when it comes to you, but do you have any special analysis that you do? Like, do you have like a lot of times there are certain times of years that you may be getting like 3, 4, 5 deals at the same time, right? So when you feel like you're ready to invest, what are some of the things that a syndicator is presenting to you that catches your attention, that you feel like, oh yes, this deal I need to look further? What are some of the quick analysis that you do on the deal that makes you want to look into the deal further versus, no, this deal I'm not even going to look at it? Is there a particular cash on cash, total return? So what is some of your techniques that you use to quickly decide, do you want to look further or do you want to just discard when you're getting too many deals at one point?
Let me see. In the order of, this first thing I get nowadays, I sometimes get so many emails about deals that the first thing I look for is who the deal sponsors are. Now, in my situation right now, I tend to look for deals that either that I really know the sponsors, already know the sponsors. I get so many emails. Sometimes they're emails that are from people that I barely know. That I probably won't be looking at that. So that's the first thing. The second thing is probably also on the deal sponsor side. How many sponsors are uh, in the on the team, and who is actually going to be the boots on the ground? Let's say who's going to be the main person, because I've asked sometimes if there are multiple sponsors, I mean, who's going to be handling the main sponsor? And sometimes you get it, oh, we're going to all be doing everything. That really doesn't sound good to me. I mean, that's too vague. Or how nowadays, a lot of the deals you have some newer sponsors partnering with an experienced, one or two experienced person. Now, who is actually going to be running the show? And this experienced sponsor, how much are they going to be involved? And what capacity are they just there to just get the loan, or help fundraise, or will they be involved in the operations of the deal? so that this is I mean even before I even look at numbers, I now I choose deals more from a sponsor point of view.
Mhm.
So now, of course, if I'm okay with the sponsors, I look at the deal location. Um, I am open to investing everywhere, but I want to make sure the sponsors are there's somebody local there or somebody that's familiar with the area. Um, and then I go into numbers. Now, numbers, when I first look at it, when you first get the pitch, the email really usually don't really have the whole full spreadsheet. So all you can do is go by what the um, uh, the returns, what their plan is, what their story is about the deal. So when you're looking at the story, why the sponsors think this is a good deal, how do they um, value this deal in the pitch that they send to you? Um, does it appeal to you basically?
Mhm.
So so once you get to the webinar or you ask for their analysis, then you go into the numbers and then see if things make sense.
Good, Jen. So you have a lot of experience now. If you look back, what things you have done differently in any particular deal or in general?
In
Uh,
general,
yeah.
okay. Well, in general, um, I know I said I wanted to go fast. I think I went a little too fast at the beginning.
Mm-hmm.
Um, I should have been maybe a little more select. Well, not select, maybe selective. But then um, hindsight's 2020. It's really hard to say from what I know right now. The things I might do different is to um, maybe look at the sponsors uh, maybe look more into the sponsor team and not just each individual sponsors, because I've had deals where the sponsors don't end up not agreeing with each other, and um, it just looks chaotic from a investor's point of view. Um, and in general, I have to admit I did fall into the uh, fear of missing out
Mm-hmm.
syndrome. When deals come by, oh, they look so good. Every deal looks good. I gotta get in every one of them, and I have no money. Ah, uh, or I have money. Oh, this one looks good. Bang, I go in. So I did fall into that trap a little bit. I have to admit. At, and I still have to be careful not to do that. So well, now I don't really have a choice. I think I'm all tapped out, so I have to wait for something to sell to invest in anything new. So I don't have that problem anymore for a while. So, but yeah, I think Chris has a question.
Yeah, you kind of started going down a path, and you mentioned about looking at the syndicators, but rather the group of syndicators and how they interacted, and the chaos that sometimes that created. I kind of
Mm-hmm.
can you maybe elaborate a little bit in some of the chaos that you're talking about, that how that the interaction kind of affects the team?
Okay, let me back up a little bit. I know that some deal sponsors, I mean, so some of the teams are actually formed after they find a deal, and somebody finds a deal. I need somebody to co-sponsor with me, and they go look for people to co-sponsor with them. Um, these teams that form just on the spot, or not, I shouldn't say on the spot, but it must be much more than that. But it seems like it's a temporary. I mean, for this deal, type of a partnership or a team.
Mhm.
I have a couple deals that they are not exactly the same, but um, it's not very clear as to who um, okay, they are not acting as a unit, as a team. They're when they deal with the property management company, when they deal with the sponsors, they seem to have different faces. Um, when I say chaotic, that's it. The property management company actually, I heard from one of the sponsors, the property management company says, okay, just one person come and talk to us. Don't you have too many people trying to drive.
Too many cooks in the kitchen, right?
Too many cooks in the kitchen. Yeah, yeah. I mean, um, so that's one particular. I mean, I'm not saying that a large sponsoring group always would have it happen that way, but there are a couple cases where I see this happening, and so for me, for now that I have to slow down, I can be more choosy. I would look for a partnership that it's a long-term partnership. It's a more planned approach. They look for properties together. They find properties. They manage it together. They have a more uniform way of dealing with everything. So
Like stability, like they're more stable and consistent.
yes, yeah,
Mhm. Right.
yeah. So yeah, there are stories.
All
Yeah.
right.
No, go
Jason,
on.
Jason had a question. Do you want to go ahead and ask her question, Jason?
Yeah. So now that you've been in so many deals, from your experience, what are some of the do's and do nots for a passive investor while in the deal? Because I feel like I want to learn a lot more information about the financials and the whatnot while in a deal. Like for example, I wanted to know the cash balance. But one of the reports that I had, one of the passive deals that I'm in, they didn't share the balance sheet. And sometimes I'm just curious about how many passive investors are there in the deal. And I'm trying not to be the one guy that's asking too many questions and bugging my deal sponsor too much. So I'm trying to get from you maybe what are the
Charles.
do's and do nots.
Okay, my answer to that is do like Charles, not like me. So, uh, as a passive investor, as far as I'm concerned, you have the right to ask for things that you want to know about the deal. I mean, if the sponsor team does not agree to give you the information you want, I see a problem there. But I know, like I said, do like Charles, not like me. Charles is, I mean, I've been a few deals with him, and he's the one that goes to the sponsor and say, "Hey, this is not right," or "I need to see this. We need to see this," and I'm glad that he's speaking up for all of us. I'm ashamed that I'm not doing all that, and so I would say if you need to if you need the information, go get it. Go ask for it. Yeah, maybe you were. Hi.
Thanks.
Yes, and really do like Charles, not like me.
What do you look in the reports when you get the reports? What things do you look for?
I mean this is a bad example. I don't look at every report. I like the executive summaries that the sponsors give us. I definitely look at that. Unless there is something that I see in the report that I don't like, or I feel it's not what I expected it to be, maybe compared with last report, and it's only when I feel like there's something that I want to dig deeper into that I actually open the actual um, numbers reports.
Mm-hmm.
I'm lazy. If I don't see anything wrong, I don't poke too much.
Mm-hmm. Mm-hmm.
Yeah, Jason.
So in one of the reports for one of my investments, I noticed there were a lot of delinquencies, like even 60-day, 90-day delinquencies, and some units seem to be vacant for over 3 months, 4 months. So what is that the type of thing that I can bring up to my deal sponsor? Because I haven't said a word or anything. I'm just like, okay, well, they're still working on it, so I'll give them a little bit more time, but I don't know what's the.
Is this are they planning rehabs or I mean heavy rehabs or something like that, or?
I think they were trying to re-tenant.
Oh, they're not leasing as fast as they want to. Is that what you're thinking?
Yeah, there were some bad tenants that had to be
Yeah.
evicted, and then maybe they're trying to fill in the units that just were turned, and so there are some units that were long-term vacant that still haven't been filled.
Mm-hmm.
But I'm just I'm seeing, like, in the delinquency report, that was one of the reports that was shared, like 90-day vacant or whatever. So I don't know if what's the fine line, from being the guy that's going to be too annoying to getting them to notice these. Did they even notice?
If they did not notice, I would be very surprised. I mean, I would say bring it up. This is something I think you can. I mean, the sponsors here on the call. I mean, this is something that you would expect people to ask, because if you have things that aren't going as smoothly as you think it should be, and there may be a reason.
Yeah.
I mean.
Yeah.
I'm not saying there's definitely something wrong. There may be a reason, so find that out.
Yep.
Yeah, I would add that even if you're a passive and even if your percentage seems very, very small, it might be 1% or even less than that, you're still a partner of the deal. You have the right to ask for any document. You should be able to ask. Some sponsors don't want to share everything on the reports, and I understand it, but if you ask for something, they should be able to give it to you. And as Yann was saying, some things might go wrong. That's fine, as long as they have a plan. So you can ask for that. Okay, I see you're having these challenges. What's your plan? How are you planning on getting out of that? And that way they also feel that their investors are committed to making them successful. Yeah.
Yeah.
All right, thank you.
Yeah, I would echo that for sure. It's I think a lot of times I see passive investor being concerned about asking too many questions, but I think we should all consider that we are part owners of the deal, and the sponsor needs to be the best stewards of our money. So I think there's not too many questions that should go unanswered for sure.
Yeah. Right.
And Yann, just I know you mentioned that you're waiting on to make further investments after some of your deals sold, but now with the with the COVID-19 situation, everything that's happening with the market right now, if you had money to invest, would you be looking to invest right now? Would you be waiting? What would be your recommendation for somebody that are trying to get into passive investment right now? What would somebody should be doing differently at this point?
For me, if I had capital right now, I would probably still invest. I might keep a little more cash on hand. I think there are mentions of if certain deals aren't doing so well, there might be capital calls and things like that. And I want to be a little prepared for that because among the 20-some deals, there may be a couple that get into that type of a situation. We're still, in my opinion, we're still early in this whole thing, so things still may go worse than what it is right now. So I may be keeping a little more cash with me, but I would still be looking at deals. I would want to make sure it's stress test properly. What if, occupancy or collections go really bad? How bad can it go for the deal to still make sense? So it's for sponsors right now, it's going to be harder for you to find things that work. And if you find something that you think it would work, I would look at it, of course. But then just I think everybody's criteria will be a little different, at least for some time, I think.
All right, perfect. All right, does anybody else have any additional questions that we haven't answered? I know we're getting to the top of the hour here, so I just want to go ahead and remind everybody of
Hello?
Yes.
Hello?
Yes, go ahead.
We can hear you, Yann.
Hi. I'm only a teenager, but since quarantine started, I decided that I'd like to learn a lot more. So I have a friend that's been sending me links. I've been trying to join as much as I can. And I know you guys are experienced, so I just figured I'd just like to throw the question out. If you were starting off right now in a market after COVID, what would you guys be paying attention to? Like, what areas? Starting yourself off. Let's say you started yourself off again after COVID, right? You were starting off first then. Is there a specific area that you think will now be affected majorly that you think you can get into that for a good steal?
That's a very good question, a very big question.
Yeah, I think it's very difficult to foresee what's going to happen and how long the effects of COVID are going to be with us, because we're, like everyone in this call is focused and interested on multifamily. I think the effect is not going to be as big in multifamily. We'll feel it for at least a year, I think. Like, for example, for our property, we're seeing collections go a little bit down, not too much. We were concerned on how much the depth of that hole was going to be, and it looks like what we are going to be concerned is not with the depth but with the length, right? How many months we're going to be under, like, collecting just a little bit less, because that little by little is going to add up. So from a perspective of someone starting to invest passively, I think we just have to follow what Yann was saying on strong fundamentals, get educated, understand what a good deal means, and keep on looking at the deals that come by. And I think same thing as this, well, not the stock market, but anything that has cycles, like anything in real estate. As long as you get in constantly, you're gonna be in good shape. Doesn't matter if you're if you're doing it in the bottom of the cycle or the top of the cycle. But again, as Jan said, the first thing is education. That will make you a good investor. Yeah.
Yeah, and I would, Cheng, I posted a link on the chat there for a free course. It's not mine. It's from somebody called Neil Bawa. He's very good about choosing the best markets to invest. And so this is a free course. I would recommend you go through it, because at the end of the day, we should be looking at, like Martin was saying, cities that have good fundamentals, and not just be looking at specific situation that's happening because of the virus. Because if you go with a city that have strong fundamentals, no matter where in the cycle they are, your chances are going to be higher. So if you haven't seen that free course since you're a teenager or just started, that's definitely something I would recommend. It's free, and it's from somebody very well known in the industry.
Thank you so much. Can I just ask one more question?
Sure.
The number one book I'm advised to is Rich Dad Poor Dad. The problem I just had with that was it tells you should get into real estate. It doesn't exactly say what to do. It just says, puts you in a ballpark without teaching you how to actually hit the ball.
Mm-hmm.
So anyone have any suggestions of books that have worked for them that are help?
So actually, I would say from that book, from Rich Dad Poor Dad, one thing that really caught my attention is that at the same time we were trying to invest in single family, and we had gone to a couple meetups about multifamily. And at that time I was reading one night, I remember I was reading the book, and he said, rich people invest on specific investments and there were 2 or 3 in there, and syndications. So at that time, I remembered, I heard about syndications yesterday on that multifamily meetup we went to. So syndication is one of those. What we do in multifamily is syndication. So that, I would say that was the first trigger for us to definitely say, okay, no more single family, let's go to multifamily. I would say if you're really interested in multifamily, a really good book is by Joe Fairless. It's called The Best Ever Apartment Investment Book.
Yes, yeah, Best Ever Apartment Syndication book from Joe Fairless. So that's a good book that goes from A to Z on apartment syndication, and for sure I would focus on like Rich Dad Poor Dad said. I mean he focused on real estate, but try to see which area of real estate you want to focus. Like this group here, we focus on multifamily, buying
Yeah, right.
apartments.
I mean, from the investment I did, multifamily seems to be the best option to go. But I'm not a fan of syndication because, if you're starting yourself off, it's hard to necessarily wait. Like you want the cash flow right away so you can keep going. You don't want to have to wait to get your returns, really. That's what annoys me a little bit about syndication.
Yep. Yeah, for sure.
Real estate in general is not a get rich quick.
Yeah, I know it's not get rich quick, but if you're waiting, let's say you put away money to start off, right? And you put most of that money towards this investment, the syndication that you're doing. And then all I'm saying is I don't think it's the greatest way to start yourself off with the syndication. I mean, would you advise someone to start off with a syndication?
Yeah, that's true. Usually you should have already some capital either from a W-2 job or from other investments to really hit the ground running. It wouldn't be something to start off like right out of high school without any capital. It would be very difficult. In these deals, there's many things that you have to put together, not only money. And to be able to get into the game, you have to bring one of those things to the table. So if you don't have money, you have to be creative with the other ones. But they're still not easy, right? You have to have network of high net worth individuals, or you have to know vendors, attorneys, property managers, things like that. So those are things that take time or money or both to generate. But as long as you start with some knowledge and start making connections and getting education, you can get it rather quickly. Like for example, first time we heard about multifamily was probably 2 years ago, and we already syndicated our first deal. We invested in almost 800 units in different markets, And we've heard of people that they have done
800 units in just 2 years. Wow.
Yeah. So it's not impossible. It's not impossible. Yeah. Which city are you on, Jaime?
I'm in Brooklyn, New York. Huh? Great.
Are
you glad to hear that?
I was
Start yourself off here.
Good. Now stay in touch, ask questions, keep coming to the meetups, and
I was gonna ask, is there another way? I'm not on the email list. My friends' emails me like sometimes when you guys have it. Is there a way to get on your guys' email list to find out when you're gonna have it?
Yes, our website. I'm gonna post the link in the chat room here, but it's multifamily021.com, and I'm about to go back to the PowerPoint for us to wrap this up. But go on our website, and you can sign up there. It's all free. And then you can join us. And actually, that actually is brings up to my next topic here, which is when do we meet again? So let me just go ahead and share my screen again. And so we always meet on the first and third Wednesday of every month. So our first Wednesday we focus on how to get started as a syndicator. And then our third Wednesday, which is today, is how to get started as a passive investor. So our next one is going to be June 3rd, and then June 17th after that. So yes, and our website is on the bottom of the screen there, multifamily021.com. And in there, if you go to the website, there's also a link to our YouTube playlist, which you can also watch all of our previous episodes that we had. So that's always a good way to, every episode, there's always some golden nuggets on how people got started. So I would suggest everybody do that as well.
And actually, the younger you start, the better. So if you're, it doesn't matter if you don't have the capital, but you have a lot of time ahead of you to get started. We all wish we had started on this when we were your age. So congratulations on that.
Thank you. It's the quarantine to think, I guess.
Yeah.
For sure.
Right.
All right. And with that, I want to say thank you to Yann for providing us some great insights. And I have Yann's email here. Hopefully it's okay, Yann, to share your email in case somebody has any additional questions for you that we can reach.
Very much, yeah. We had a really good time. Thank you.
Yes, Yann. Thank you.
We appreciate your time for sure.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.